Despite their attempted rebrand to Alphabet, everybody still calls Google Google. That's because it's the third most valuable brand in the world, and it's owned by the fourth largest company in the world. Google's technological aspirations range from smart contact lenses to autonomous driving to quantum computing. The cash cow driving all this? Ad spend and soon cloud computing. So when one of the world's greatest technology firms invests in other companies, investors take notice. Today we're going to look at the portfolio of 45 companies that Google holds to see what insights we can uncover. So firms that have a portfolio of publicly traded stocks greater than $100 million need to file a 13F form. So you can simply go to the SEC database, filter on 13F, and then look at these forms. Here we've highlighted the two most recent, and of course you can compare the most recent to the one before it to see what changes have taken place. Rather interesting information. So Google's holdings, $1.9 billion worth of stocks, 43 total, and 13 of those account for 95% of the portfolio. That's what we're going to want to focus on. 30 stocks account for 5%. Let's start with the largely irrelevant 5%. The first thing that we did was filter on the word therapeutics, and you can see 15 stocks on the right, all quite low weightings and all containing the word therapeutics. On the left, you can see the remaining 15 stocks, all of which, except two, are involved in healthcare. So these 30 stocks are very healthcare focused, and that makes you wonder about Google's healthcare aspirations, which largely surround this Verily component of their business. You see the latest from their website here. It says making healthcare more precise and how their unified platform is going to power their AI plus solutions and services. So we've been watching what Verily has been doing over the years, in particular things like their smart contact lenses, and this last piece that we did was around 4 years ago. Verily Life Sciences leads digitization of healthcare. We looked at the various components of that business. It's still a relevant read if you're interested. Now, when you're looking at what contributions Verily makes to Google's business, you can go here into their revenues and see that under other bets, that's where Verily would fall. We don't know what percentage of other bets Verily accounts for, but perhaps what's more interesting is when you look at segment profitability and see that other bets, in fact, it lost $4 billion last year and around $4.6 billion the year prior. So it's making up less than 0.5% of revenues, but it's making up a sizable loss of profits. So what Google has decided to do, apparently, according to a leaked document, is they plan to make Verily a standalone entity and disconnect it from Google. This piece by Benzinga builds on a business intelligence piece which offers up largely the same information. They refer to this LightPath AI-powered platform for chronic care, something that's new to us. Apparently, employees are already being issued new email addresses, losing access to Google benefits and infrastructure, and there's a potential IPO being dangled as a carrot for the Verily employees who may be worried about their move away from Google. Now, when this happens, what will Google do with all their healthcare holdings that we looked at? Well, one thing is that we don't know what actually belongs to Verily. So when we look at the core of Google's portfolio, the 95% in 13 names that you see here, firstly, most of these companies are in our catalog, so we cover them and have researched them, and you can find that research on our website. But the question is, how did Google end up holding these names? And if we can answer that question, we may understand better what they plan to do with all those healthcare stocks that they're holding. So actually, Google has three investment arms. You have Google Ventures, which is traditionally the one that you think about when it comes to Google investing in startups. You have CapitalG, which I only learned about today, and Alphabet, of course, the mothership. Now, when it comes to Google Ventures, they operate on long time horizons and deals in decades, not rounds. So they're different from a traditional VC. They talk about how they don't invest like a typical corporate venture capital arm in that they're trying to complement existing areas of the corporation that they work for. Instead, they prefer to operate autonomously and capture alpha in a way that a VC does, except with a very long horizon. So they launched in 2009 with a $60 million capital commitment. They now have over $10 billion in assets under management, rather impressive, 400 active portfolio companies. And some of their notable investment outcomes, they list things like Uber, Slack, GitLab, Flatiron, Verve, One Medical. So this piece by Fortune is quite good, and it's rather recent and looks at Google Ventures' aspirations, the past 15 years of progress they've made and their plans for the next 300. The article cites some interesting bits. As I said, this is an independent venture firm rather than a strategic corporate venture arm. They've doubled assets under management in the last 4 years or so. They announce an average of 50 new portfolio companies every year since 2020, and so far they revealed more than 30 companies in 2024. They deploy about $1 billion annually in new and follow-on investments. Their largest investment ever was $335 million into Uber in 2019, and they exited at the IPO. And this raises a question of when this venture arm decides to exit, because not all companies they've invested in, they've exited at IPO. We'll look at that. Their second largest investment is in Cribble. This is a unified data management platform I've never come across. Will invest in anything, they say, but they also see a future in life sciences practice. So going back to that heavy healthcare focus of publicly traded companies they have, Google Ventures is responsible for about 30% of the names that we're going to talk about today, that core 13 that account for 95% of their portfolio. Now, the other venture arm they have is CapitalG. They describe it as an independent growth fund, $7 billion in assets under management. Resources, they say, to help you grow with typical investments of $50 million to $200 million per company. They've had 16 IPOs, 9 M&A exits. They give some examples of firms they've invested in and helped: Gusto, Duolingo, CrowdStrike, Credit Karma. So when we look at those 13 firms, here we can see which investment arm of Google was responsible for bringing these publicly traded companies into the fold. It's interesting to note here, I've made some comments. So for example, Revolution Medicine, they decreased their holdings last quarter, so then you can pay attention to those moving up and down. As I said, another example is Prime Medicine, that saw a significant expansion last year in investment from Google. You see Dexcom and Snowflake here. Alphabet ended up owning shares because of a strategic partnership, so that's important to pay attention to. Planet Labs, they hold because Planet Labs acquired Google's satellite imaging business, and this move to invest in Tempus AI with an initial convertible promissory note showing some creativity from Google's investment team. So let's talk about the 51% of their portfolio that's held in 3 names: GitLab, ARM, and Revolution Medicine. So you see here this article from TechCrunch talking about how Google Ventures first invested in GitLab. So clearly Google didn't exit that very large position when GitLab had their IPO. That's interesting. Some people are speculating that's because they might acquire GitLab, but the latest numbers are rather impressive. The last time we checked in with GitLab here, we talked about the generative AI opportunity. That was in March of last year. That means we're going to revisit them in March of this year. You see that we had listed 26% expected growth in fiscal 2025. Numbers are off in that chart, but they're actually expecting 30% growth, quite strong. You see the numbers, the above there, a net retention rate of over 120%, which is great. They're cash flow positive, which means they're not burning cash anymore. So very solid company that's actually rumored to be exploring a sale, at least according to this article by Reuters last summer that said Datadog, interestingly enough, was an interested party in a potential GitLab acquisition. They were facing pricing headwinds competing with Microsoft GitHub. Indeed, that would be the case. Microsoft can afford to compete on price, and they said investors view Amazon or Google as more obvious buyout candidates. But these speculations about buyouts and $5 might get you a cup of coffee at Starbucks these days. So when we move on to looking at ARM, they had their IPO and Google was an investor in that. We wrote about the IPO. This was back in August of 2023. You can see here we concluded that once the dust has settled, we look at how the valuation was and what additional insights we could find. Current valuation sits at a simple valuation ratio of 43. That's twice of our limit we'd consider investing at. So very richly priced, but also there's gross margins of 95% and upwards are very appealing. This is a very attractive firm. It's probably useful to use price to earnings instead of our simple valuation ratio because it's so profitable. So I've added this to our research queue for a follow-up article. That brings us to Revolution Medicines. Here you can see their clinical development pipeline. And we don't really have interest in cancer drug developers. Our recent piece on cancer blood testing talks about that, in that these are more obscure and niche applications for cancer drugs. We're more interested in holistic things like screening, right? So there's over $100 billion opportunity for cancer blood tests that can be used to screen, because the cure for cancer is largely early detection. So this wouldn't be something that we would have any interest in. Moving on to names in that list that we cover, CrowdStrike, a leader in cybersecurity, and of course AI for cybersecurity. We have an annual checkup coming out soon that's been assigned to someone. Dexcom, this was recently moved to a void in our tech stock catalog. That's because revenue growth appears to be slowing. That's due to management missteps and competitive pressures from the likes of Abbott. There's also Ozempic on the horizon, of course, the weight loss drug that threatens all the overweight people who have diabetes. Then there's UiPath. They need to manage this move from robotic process automation to what they're calling agentic AI, and they have this new Auto AI pilot, and they have all these demos. It really has Palantir AIP vibes to it. Comes down to growing revenues, and UiPath, for whatever reasons, building their own foundational model and staffing up their internal AI team. We have an update in April, and we'll see how that's progressing for them. Prime Medicine. So the gene editing theme has really been in a slump lately as investors turn towards shinier things. But there's still promise, of course, that editing genes can create therapies for diseases that are previously thought to be uncurable. So Prime Medicine, they have runway into the first half of 2026. Their technology is thought to be a sort of find and replace, very specific and accurate method of editing genes as opposed to the CRISPR method, which is a little bit more bulky. They're on track to report some initial data from a phase 1/2 clinical trial this year. They had a recent deal with Bristol Myers Squibb that adds cash to their coffers. We've made our bets in other places when it comes to gene editing, so this isn't a firm that we follow very closely. Continuing on with names, we cover Snowflake, a play on the growth of big data. Their growth has now slowed to just 26%, something we covered in our last piece on Snowflake. They're playing catch up on AI, trying to keep up with Databricks, and I think their data breach is now behind them. That created a potentially buying opportunity with their stock. We're going to revisit them in August. That brings us to Planet Labs. They're managing a 10% growth this year, or double digits that we're looking for, barely. Management really dropped the ball on forecasting, and their execution seems to have fallen off a cliff in the past year. So we're going to revisit them in April. Then you have Tempest. So we covered them just around the IPO time. It's probably due for a revisit because the IPO dust has settled. They're showing strong, consistent revenue growth. So we're going to revisit that firm shortly. Then it brings us to the new names that were on Google's list. We haven't looked at Freshworks. They're the first Indian SaaS company to be listed on NASDAQ. That's been raised a few times by subscribers. So if there's a premium subscriber watching and you're interested in having us cover that, put it in our Discord community. We'll add it as a poll and everybody can vote on it. They build cloud-based tools for CRM, IT service management, and e-commerce marketing. So a jack of all trades. We're more interested in the leaders in any of those niches as opposed to a jack of all trades. Perhaps they're servicing some smaller segment of clients. It could be geographical segment. I'm not sure. But we also have Verve Therapeutics. The big appeal of Verve that I can recall was their gene editing medicine designed to provide a single course treatment to reduce cholesterol. So no more cholesterol drugs that elderly people seem to be taking. That didn't pan out so well. I believe they paused those trials. They're now focused on Verve 102. So some of the appeal there has been eroded. And there's Sana Biotechnology. They're focused on utilizing engineered cells as medicines for patients. You look at their pipeline, and I gave it a cursory look. When we see pipelines, we look for large pharma partners who can help support the costs and provide funding. We want to see platform factories with multiple large pharma partners that are churning out drugs as opposed to a firm hanging their hat on one or two lead candidates. So just some concluding thoughts. Google Ventures is not like other corporate venture capital arms, which I was quite surprised to learn. The CapitalG investment arm focused on later stages is rather interesting. They also have Alphabet, the company, investing in publicly traded stocks or privately held firms for various reasons. All these investments that Google holds in their portfolio occurred for various reasons, and they need context. So like the moves of active managers, changes in Google's investments over time really don't tell us much. Now, the spin out of Verily may have some implications for their healthcare holdings, but I left this whole thing wondering, how does Google decide whether to hold shares of a company they invested in a while ago post-IPO or not? So they exited Uber, but they decided to hold on to CrowdStrike. So I found all that rather interesting. Now, another firm that everybody watches very closely what they do, perhaps more so than Google, is NVIDIA. We recently did this piece on a NVIDIA AI investment for a little-known company. Check that out. Give that a watch. Thanks so much for taking the time to watch this today.